Hi there, it's Bill with Smart Trades, and today is Tuesday, August 30th. It's around 12:25 p.m. Pacific Time. And as always, please visit smarttrades.com if you'd like more frequent updates, including live tweets via Twitter. And also, I have a newsletter that goes out several times a week at smarttrades.com. Anyway, S&P 500 cash here. This is a daily chart, and as I've noted before, I'm looking for the potential for a bounce back to the neckline of this head and shoulders top. That would be back around 1260 or so, perhaps a little higher, perhaps a little lower. But that's the general idea, and so far it's worked out pretty well. We are rallying. We have hit an area where I'm a little concerned that we're going to see a short-term peak. I can count 5 waves up, and this could also be counted. I've got it counted as a 1-2. You could count this as an ABC. That said, I think there's other indications that we may have higher to go. In particular, the advanced decline line. What I show here is the NYSE advancing issues as a surrogate for the overall breadth, and this horizontal line here, as noted, is the 2700 advancing mark. Now, we've had, I count 1, 2, 3, 4 rallies where we've exceeded that 2700 mark. That's a very powerful number. Usually you don't see those kinds of breadth ratios in a bear market. That said, I do think that we're in a bear market, both in terms of the very big picture and also in terms of the short-term picture. That said, those breadth ratios are pretty impressive. But to bring it up to date, we do actually have a bearish divergence here on the breadth short-term, and we're right into resistance. A small previous fourth wave peak comes in right around 12:15 or so, and 12:20, as you might remember, is that major peak from April 2010. So we're into a very important area for the market here, and if we can penetrate there, I think that 1260 is a pretty good bet. But if we fail here, there's an alternate, more bearish count, which I'll get to in a moment. That said, again, here's a review of the more bullish short-term scenario. This allows, again, for the rally back to this neckline. That comes in around 1260, give or take. And then you'd have 2 equal legs down to right around the 2010 swing lows around S&P 1000 or 1010. Here's a longer-term chart. This is the Dow monthly. And again, as per my last video, I see this the decline from year 2000 as just A. We are currently working on a B wave, which could actually eventually take us back up above 14,000. Anyway, in the meantime, I think that we've got lower to go in B of B, if you will, and ideally, again, that area around 9600 would be the equivalent to S&P 1000. However, we certainly could go lower than that. The area around 7850 or so would set up an A equals C up around 14,200, up around the 2007 peak. So that fits nicely as well. Anyway, these are all obviously, months and months, perhaps even a couple of years out. So I reserve the right to, review that as we approach these targets. And that said, next major move down, perhaps to down 9,600, perhaps as low as the 7,850 area. And then up possibly again to 14,000 plus. Here is the more bearish short-term count basis the S&P. In this case, we count 5 waves down with a failed 5th, down around the 1120 area basis the S&P cash, and from there you can count again that ABC, and here's that bearish breadth divergence on the current rally. Previous fourth wave resistance, depending on which magnitude you want to look at, comes in around 1210 or 1215. And we are into that zone right now. S&P about 1214, make it 1215 as I speak. Also, one possibility, even in this bearish count, is that we are going to go back up and test the neckline. One of the things that I don't like about the current price level as a peak is that it's too short a correction, both in terms of time and perhaps price. This is a failed fifth, which is, I think, the best way to count it. If you're counting this as 5 waves down, failed fifths by definition tend to be rather bullish, at least on the short term. So you would expect a rather decent sized wave 2 rally. And again, 1260 is certainly a possibility, even in this quote unquote the bearish count. One other thing, that 1260 area is going to be just about 62% of the decline down to the 1100 area. Here again this is that bearish count, looking a little further out, counting this as a wave 2 peak, and then another 1, 2 down, and again 1260 being the ideal area to look for a possible peak for wave 2, or B if you prefer. One other thing, I mentioned this chart on Apple. This actually came out in the last video, which came out before Steve Jobs announced his retirement. It is rather interesting, I think, that on a semi-log scale we do have Apple forming a near perfect 5 waves up right into his retirement. It's a little ominous for the market. I had mentioned that a previous 4th wave low in this count is down around 80. That said, the range of the previous 4th wave is the range of the target for the next correction. So it's not inconceivable that Apple could decline, not to 80, but perhaps to the range from 80 up to about 200, if, and I emphasize if, this count is indeed correct. One thing to note, and I think even Prechter will acknowledge this, is when you're looking at individual stocks and commodities, Elliott wave counts are not as pertinent and not as reliable. So I'll take this with a grain of salt. Nonetheless, it is a rather perfect looking 5 waves up for Apple. I've heard online folks looking at the Chinese markets as being in a triangle. Now, it certainly is possible they're in a triangle. However, I don't think the triangle starts on the 2008 low. If we are indeed in a triangle, I think this best counts as a triangle actually from the 2009, the first 2009 peak, in which case you would count ABCA, ABCB, and we're working on C, and possibly completing C of the triangle here. This fits also with the picture in the Dow to some extent, in that the Chinese market might not dip quite as low as the U.S. market on a relative basis. Gold. I had mentioned before that previous 4th wave support came in that 1725 area, I believe. You can see, although we have a dip down below that level briefly, a long-tailed doji here, as I call them, did manage to hold that level. I think that we still look like we may have a top in gold, probably going to hinge somewhat on what happens in the market. If we see that more bearish count, it's likely gold's going to go higher if stocks go down. On the other hand, if stocks can continue to go sideways to higher, I think that we probably have seen, at least on a short-term basis, a top in gold. There is resistance up above here in that 1850, 1860 area basis, the lead futures contract for gold. Crude oil. As I've mentioned before, I think we're into a corrective rally here. 90 is obviously resistance. I think we could go a little higher, though. I think the top of the channel and also an A equals C type pattern takes us up to about 92 in crude, but I'd watch this carefully, obviously, with the Libya situation. And finally, bonds. Here's TLT, the 20-year bond fund. And I do believe that bonds also look like they've at least put in a short-term peak or an intermediate-term peak. Support for the bonds is down at that previous 4th wave low around the 103 level. If we take that out, I think that potential goes down to about 98 or so. That said, I'm not clear here on the bonds on the short-term or the longer term in terms of the context of this count, but it sure does look like a nice 5-wave picture. So I would at least be looking for that correction down to 103 or so, particularly if the stock market continues to hang in there. And just an update as I speak, the stock market up, the S&P that is, up above 1218. And so we are indeed moving higher. If we can get through 1220, I think that really favors a strong close above 1220, favors my more bullish count. And so we'll see how it turns out. Anyway, that's about it for now. Again, smarttrades.com if you want updates more often, and live Twitter comments throughout the day. Hope you're having a good one. Enjoy the holiday weekend, and thank you so much for watching. Bye-bye.